the host of today's event. Very, very grateful that you're all here. Mike Rice and I started in about 2012. We had 50 people down at the NISA offices in Times Square, so it's grown quite a bit. Now we'll have probably about 700 people here today. So I'm very, very grateful for your participation. I'm also grateful to have, childhood friend like Mike Rice and Peter and JC. JC is the founder of TrendLabs, legendary technical analyst. You've seen him before around. Peter has worked, right now he's a board member of CIBC, worked with Paul Tudor Jones. And it's worth noting that back in 1988, over Chinese takeout at Paul's apartment, they thought it would be quite something to put an organization together to give back to New York City, since this is where we all made our bones and cut our teeth. I'm a commodity guy. And with Maurice Chesa and David Saltzman, Glenn Dubin, Paul Tudor Jones, they founded Robin Hood Foundation, gave away, $65,000 the first year. And through this year, they're just under $3 billion of investment. So it's a great honor to be your friend. I'm very, very, very proud of what you do there. That's quite something. So there's a lot going on in the world. You don't know what's coming out of Washington on any given day. Let's set up the backdrop here, right? Looks like the stock market is slowing down, maybe wants to roll over. The dollar is getting weaker. The 2, the 5, the 10, and the 30-year look like they're selling off. At the same time, we have $6.95 trillion in cash on the sidelines, down 1.2% from what looks like the all-time high. We're also dealing with $850 billion of margin balances, right, which could unwind. So we're going to use that as the backdrop to today's discussion. Peter, start with you. What do you think that the government's policy is with, the Fed and the interest rates? Are they trying to cut the deficit, or what do you think their strategy is here?
Well, first of all, thank you kindly for those words, and it's a pleasure to be here. I'm going to try to start immediately with some audience interaction to address that question.
Okay.
So how many people in the audience think the Fed is going to cut in 2 weeks, cut rates? Anybody? Okay. And how many think they're going to cut in September? See, so now you are exactly living what my favorite line is, that the most popular job for a Wall Street analyst is every 3 months forecasting that the Fed is going to cut in 3 months.
A lot of money, too.
Yeah, a lot of them get paid a lot of money. So if you think about where we are, so I'm fortunate. I've been in the business a long time, and now I sit on the risk committee of CIBC. And one of the things about risk, and JC can get into it, if you can't model it, you can't price it. So how do we model and I don't know what word to use. So let's just say the epsilon, right? The epsilon is the uncertainty, craziness of policy in Washington. If you're the Fed, and how in the world do you think you can lower rates in a world where the dollar's getting weaker and all the other things that he said? Markets work. That's the one thing I'm certain of. And so where is water going to find that level? It's likely to find that level. Every policy right now coming out is driving rates higher. So I think in September, once again, you'll be raising your hand to cut rates in December.
JC, I think it was Paul Tudor Jones who actually said price moves first and the fundamentals follow. What do you think the charts are showing on bonds? Pick a number.
Bonds. I'm an equities guy first, but I'm intermarket analysis is really where it all begins for me, and then I ultimately get to equities. And the bond market is always a big question mark, whether we like it or not. And I get asked about stocks, and I start talking about bonds, right? This, in my experience, what the stock market doesn't like, what creates volatility, is when there's volatility in the bond market, right? So it's not so much the direction of bonds and rates as it is the rate of acceleration, right? And you can make a similar argument to the dollar, right? Dollar got smoked in Q1. And look at the havoc that caused all over the world. It was the widest dispersion in returns between U.S. equities and international equities in the first quarter, like widest dispersion ever, depending on how you measure it. I mean, just 20% returns in countries around the world, with equities in the United States down at the averages. I mean, just massive, disruption. And I think that, there was a combination of a lot of home country bias in America, right? I mean, we're Americans. We don't need to invest overseas. We got plenty over here, right? That's how we think now, right? It wasn't always like that. So I think that, and then also the recency bias, right? U.S. outperformance for so long. So I think that there was just a massive extreme in positioning that was due to unwind anyway, and then the dollar getting smoked accelerated that further. So I think for both the dollar and yields, at the end of the day, they've been in really a range for the last 3 years. And, the stock market is putting up banner years, right? Think about the range that the U.S. 10-year yield has been in over the last couple of years. You had a 24% year in the S&P in 23. You had a 23% year last year. This year, stocks are flying all over the world. Just because the U.S. is underperforming doesn't mean stocks aren't flying higher all over the world. So the stock market likes this like choppiness in rates. So, Peter and I were talking earlier this week or last week, and he was talking about, a big potential secular shift in yields higher, where we are in a rising rate environment for the foreseeable future. And these cycles don't just last a couple of quarters or a couple of years. We're talking decades, right? So there are massive secular implications to, Peter's thesis, and I'll let him, elaborate further. But, I have a hard time disagreeing with him, right? These things take time to turn. I mean, we're talking about a 40-year trend that could potentially be turning. What I would remind everybody, and what I like to remind myself, is that understand what time horizon you're talking about. Are we talking about this month, this quarter, or are we talking about the next 20 years? These are two different conversations. So I think while the secular shift in yields for the decade plus is definitely on the table, I think probably a higher probability outcome than a lower probability outcome, but that doesn't change the fact that yields now are still range bound, and the stock market likes that. So that's really where I'm focused on, putting Peter's thesis into context and understanding and agreeing, quite frankly, and then also remembering that we're trying to make money this quarter.
Just to follow up, so the issue with the bond market and the currency market, so the equity market tends to be the last to respond if you look at history. And what we're seeing today, and going back to your earlier statement, the way that we look at markets mostly is price makes news, not the other way around. So if we go to April 9th, when we had that reversal, bond yields today are where they were then. So trading is often a second derivative. It's the rate of speed at which a market moves. And so that gets into all sorts of other trading strategies if one wants to discuss it. So we're here now, but because it's not a story, because we're already there, and the change has been very slow, right? So the first derivative has just sort of flattened out, as JC was just saying. So if, and I don't think it's just an if, I think when bond yields break out to the higher side, that's when you're going to see further stress in the U.S. equity markets. The question is, historically, right, higher yields tend to be good for the dollar. So you have to listen to the market. The markets are saying something here that we're completely lacking in fiscal discipline. Now, we've had a tremendous run in the U.S. equity market relative to the rest of the world. Now we're sitting at a point, and you have to ask yourself rhetorically, if we're taking 50 years of policy, which has led to tremendous U.S. growth, both on the wealth side and the equity side, rising standard of living, and we're turning it upside down. Why would one expect to have the same outcome? So for you all sitting in the audience, it's brutal, because you guys are like general managers of a sports team, right? You've got to pick the players. Now, whether that's your allocation among your ETF strategy, whether you're in alts and you're trying to choose your managers, you're always subject to second guessing. And that's really hard. But if you're building a team for the future, right, you want to win tomorrow. You don't want to rest on your laurels from yesterday. You've got a really difficult job, if my assumption is correct, that we're in the very early stages. Remember, we're still in the hundreds and days of what's going on here. And the uncertainty is growing every day. So, you need to put points on the board, but defense wins championships.
Yeah, that's right. So with that, we had the advent of, bonds taking out 110. Looks like the dollar index wants to take out 98. I haven't seen too many times where, when we came up, Victor Sprandi would tell me, like, remember, stocks need bonds. Bonds don't need anybody. So we have the advent of bonds selling off, rates going higher, but also a weakening dollar, which is typically antithetical, right? Because I always learned that the higher the rate, it supports the local currency. Do you see that as being, divergent?
The market is telling us, and he spends all his time looking at these technicals, that the U.S. is losing the confidence of it around the world, not only in the relative performance of equities, but also the relative performance of bonds to its interest rates. If you look at sort of where debt to GDP goes in terms of crises in other countries, whether you can look at Mexico in the 90s, whether you can look at Greece, when there's a lack of investor confidence, rates have to go up very quickly to try to stabilize the local currency. Now, we're fortunate in a lot of ways, right, because we issue our own debt. But just a little quick history lesson. So if you look at World War II and you look at COVID, right, in World War II, we financed it with public debt. We lost a lot of people in the war, and bombing disrupts a lot of supply chains. COVID did the same thing, right? We financed it with public debt. We lost a lot of people, unfortunately, and supply chains were disrupted. Post-World War II, the policies were all sort of the same, except for one, right? To try to reduce the deficit, so the Fed tolerated slightly higher inflation, so we need to think about that. We tried to bring down the debt to GDP, which is what we tried to do here, except by the time President Eisenhower took hold in trying to reduce the deficit, the public deficit, anyone, I show a hand, what was the top marginal tax rate in 1955? Yeah. What? 99. Correct. 91%. And so think about that for a minute. So, of course, just another history lesson, right? It was a Democrat, John F. Kennedy, who reduced the top rate. Then when Reagan came in and reduced the top rate to 50%, the beginning of my career, everybody was throwing a party. Holy shit, right? Rates are half of what they were. This is fantastic. And the 80s took place. Now we're going through this amazing fight over whether the top rate should be 36 or 39. But we know one thing's for certain. If we continue to raise the level of debt, remember there's a stock and a flow. So the stock keeps going higher. So the flow on top of that, right? So if you're like, okay, we got a 6% GDP deficit, we cut it to 3, but at the same time, you've got a higher base, that 3% is still increasing a lot of debt. that market is going to fix that through higher rates and a lower dollar. So that's sort of my history lesson. Then JC can go into where we are technically and how fast we think that's potentially going to happen.
So with that opens, that's a very pregnant statement, right? So are we looking at foreign currencies, international equities, like that chart your colleague Louis put together showed the S&P, commodities, where do we go from here, JC?
Yeah. So, when I think about foreign currencies ripping around the world, Polish zloty or złote, as I was corrected recently by my Polish nanny across the street, says złote. I'm like, okay. Making new multi-year highs, just emerging market currencies doing well. Rotation into China, massive outperformance there. Israel continues to make new all-time highs despite, any negative sentiment that we've gotten out of there over the last couple of years, which has been outrageous, and it continues to make new all-time highs. So when I see these things, I think less about rotation out of the U.S. and the U.S. losing its gold standard around the world and people trusting U.S. less. Maybe there's some of that that's true. I don't know. I'm not an expert at that. But what I can tell you is that if these emerging market currencies are flying and money's going into Chinese stocks, it's probably not risk off, right? European banks, the European bank ETF is making new all-time highs. I don't see that as a bad thing for the equities market. You know what I mean? I guess call me old-fashioned, but if the world's falling apart, Deutsche Bank is going to be leading the charge down to zero, right? I mean, come on. So I don't see those things as overall negatives. Also, when you bring it back to the U.S. equities market, every bear market, every down cycle for equities ever has had, what my friend Ari Wald at Oppenheimer calls the culprit, the sector culprit. Whether it was a dot-com bubble, you had all these tech and dot-com stocks get destroyed. They were the leaders of that down cycle. Great financial crisis, you had the homies and you had financials. They were the leaders of that down cycle in 21, 22. All those ARK funds, Cathie Wood was, the next Warren Buffett, and those things got smoked down 80, 90%. And I'm not so much picking on her, not at all. It's just those types of stocks were really the poster child, include Chinese internet, biotechnology, all those solar names. They all peaked in early 21, well before the overall market. So those were the sector culprits of that cycle. So when I think about, okay, is the world going to fall apart like everybody keeps telling me? Maybe, but which is the sector culprit? What's going to lead it to the downside? Is it semiconductors? They're not breaking down. Quite the opposite. They've come back ripping. Technology is up 12% this quarter, right? And leading the best sector by far this quarter. And then when you think about the defensive rotation potentially into utilities and consumer staples, I would add that part of that top 5 performers this year is also industrials, financials, and communications, not defensive, right? So I'm not seeing this pure defensive rotation. So, that leads me to believe that, at least it has been and continues to be, how do we want to spend our time? Should we be looking for stocks to buy, or should we be spending our time looking for stocks to sell? And the answer continues to be we want to be looking for stocks to buy. And sector rotation is the lifeblood of a bull market. Shout out Rafa Campora. And that's what we're seeing. We've been seeing sector rotation. I mean, so I have a hard time buying the risk off. I got to see it.
Trammell, are we going to open it up to questions? Okay. Hang on, I got to get you a mic.
Given the current shift in long-term trends, interest rates, geopolitics, all that, how would you recommend you position commodities inside your portfolio?
Hi, Brett. I'm JC. Nice to meet you.
Peter, go first.
So again, I listen to the markets, and I kind of always, when I look at commodities, I look at the 7 C's, starting with crude, corn, copper, cocoa, cattle, what else? Oh, cotton and coffee. And so I look at that as kind of in index. So clearly, this, and then looking at that as a potential inflationary indicator, and then looking at that as, is it going to put further stress on bonds? So we just talked about the fiscal situation, the stress on bonds. Everything points to stress on bonds and international uncertainty. There's this giant cross current, right? Pressure on commodities potentially in the United States because we're not going to export as much, right, because of the tariffs and the retaliation. On the other hand, global commodities, cocoa and coffee, for example, have been near record highs for a while. So in terms of positioning, I absolutely think that it's important. And if you don't want to trade, you should have some sort of exposure and ETFs to commodity markets. Never mind gold, right? You want to be long gold, of course. And if you need to hedge that, you could be short silver against it.
JC, same question.
The 7 C's. I like that.
That's impressive.
I like that. Write that down. Somebody, Patrick, write that down. That's a good one. Definitely stealing that. You know, a funny thing happened a few years ago when all these, ARChy stocks blew up in 21, in 22. You had the stock market selling off in the first half of 22, right? Traditionally, for a long time, my entire career, most of ours, the bond market acted as a defensive mechanism that would help balance out the risk of equities. You'd get that bid in the treasury bond market, right? We saw it for many, many years. In 22, when stocks were selling off, bonds were getting hit harder, right? You want to talk about funds blowing up. I mean, that just, all the computers were exploding when that happened, right? So let's think back to how long it's been since we've seen that. In most of our careers here, I'm looking around, most of our careers here, that's never happened before, right? You always get that defensive. In fact, I could tell you in Q4 of 2018, COVID, even prior to that, I remember being super bearish equities and not even looking for shorts, just buying bonds, right? Like that was just the move, and that completely changed. So when we talk about commodities, like, the 60-40 portfolio of stocks and bonds became the 100 portfolio, right? Because they were moving together. So when you think about what's that 40, the argument for me is not, is it bonds? I think is it gold, or is it gold plus energy, right? Like, what is that 40 composition look like? One day I'll wake up and I'll be like, because for me it's all hypothetical. I'm not actually allocating that way, right? But I do like to think about how others have to allocate it so I can exploit that for my own selfish benefit, right? So I'm thinking, is it 20% energy stocks and, XLE plus GLD as the 40? I don't hate that. And these days, like just kind of thinking in general, particularly with how far gold has run and then copper following, what comes next, in theory, it's energy, but we're at the New York Athletic Club, on stage with Peter Borish, so that's pretty cool. But we're at the Athletic Club. What was it? Yogi Berra? What is it? I don't want to like misquote a Yankee in New York City, but like it's something like in theory, practice and theory is the same, but not in practice, right? Something like that. So I read in a book recently that I forget what book it was, and it said that the mind is like a parachute, right? Because it only works if it's open, right? I was like, oh, I really like that. So I really want to just keep an open mind, particularly with the intermarket implications in the market. It's really easy to overthink the dollar. Well, the dollar does this, then China's going to do that, and then copper, short soybeans, what? So like, don't overthink the intermarket analysis on the dollar, on the bond market. As somebody who has overthought the intermarket analysis a lot over many, many years, I can tell you, don't do it. If you don't like bonds, just short bonds. If you like the euro, buy the euro. Don't buy like a third derivative, right? So that would be how I would look at it. So the answer to the question, what do I think about commodities? I like them. And then let me remind everybody that these commodity cycles don't just last a few quarters or a few years. We're talking decades, right? So look back and study commodity cycles. They last for a long time. So when I get asked, I was with Brian London the other day, who like talks to like every gold guy in the world, right? And we were just talking about how high the price of gold can go. For me, it's less about how high it can go in terms of price, and I'm more interested in for how long can it go up, right? I'm more interested in the duration versus the amplitude of the future, particularly with commodities. So that's how I think about it.
We've come to the end of the session. We've run out of time. I want to thank J.C. Parets of TrendLabs, Peter Borish, board member, CIBC. Thank you, everybody.